Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today I want to talk about a subject where we've got a clear conflict of interest because, of course, we run a holistic accounting business and, of course, it's in our favour to, articulate why people shouldn't choose accountants based on price. So I just want to put that out there right from the get-go. I acknowledge the conflict and we do our very best to remove our commercial interest from this podcast, right? We don't sell anything, we don't try and plug our own business or anything like that. Our approach is to try and educate. And whilst we do have that conflict of interest, I think we've got another side of the coin to share with you. We can certainly see how clients perceive our holistic accounting business, but, we get the benefit of seeing what happens behind the scenes. And what we wanted to do is kind of share that with you today because, there's a lot of people out there that will really just choose an accountant based on price. And really, in the absence of any other measure of quality, we understand that quite often we defer to price as a measure of quality when we don't really understand the product, whether that's accounting, whether it's choosing a lawyer, whether it's choosing a builder to build a home, these sorts of things. Quite often price is a very useful, well, not only useful, but a very common indicator. And, accounting seems like a commodity style product. Produce my financial statements, lodge my tax return, make sure I comply with the tax law so I don't fall foul of the ATO and stay out of jail and all those sorts of things. And it seems quite binary. It's either done correctly or it's not done correctly. And that might be true for, very simplistic situations. But as businesses increase in complexity, they start to have more moving parts and it starts to require more judgment rather than just a process. A process is a commoditized product. Judgment is not. Things like multiple entities, retained profits, who are the shareholders, what are the growth plans, what are the future planning, tax planning we need to do for not only this year, but future years. All those sorts of things require judgment, and judgment is not a commodity.
And that's where really the disconnect is. Most business owners are very capable in their own domain, but they're poorly equipped to assess accounting quality. And that's not because they're unsophisticated, but because the consequences of poor accounting advice rarely fail sort of loudly. We've had instances where clients have operated very large scale businesses, but the structure has been so poorly set up that they just compound, and we only realize that it's an issue when they try to wind up or they sell or something like that, or divest. So they don't explode in 1 year, they quietly compound. So from the business owner's point of view, the annual tax return looks fine, the ATO is not auditing me, the numbers reconcile, but underneath that, structural decisions are being locked in and they're not the right decisions. Opportunities are being missed, risks are being deferred, and often no one is joining the dots across the years. High quality accounting is not about getting the answer right for this year, it is about understanding how this year constrains or enables the next 5 years.
And that's why price feels so seductive. If tax is just compliance, then cheap is a very rational decision. The cheapest price wins. But compliance only looks like compliance if you ignore the judgment embedded inside it. And this is where I think people miss the big picture because they don't understand where that judgment is. Even something as simple as how you extract profit from your trading entity, whether it's wages, dividends, using a family trust, bucket companies, so corporate beneficiaries, Div 7A loans, all these sorts of things. Each of those choices have sort of different cash flow, tax, timing, risk, future flexibility. They all have, different implications. And if your accountant's job is either implicitly or explicitly just do the tax and keep the ATO happy, then they're naturally going to defer to, maybe what is easiest for them or what they do most commonly, which might not be the right approach. So there's no real strategy there. And so habits usually are shaped by efficiency, not necessarily optimization for every single individual client.
And people really look at it from just the entity point of view, so that the company that's trading. So let me use an example for this discussion. Say you're operating through a trading company and you got two working shareholders and profits sort of steadily growing, and your BASs are being lodged. There's no errors, like I said before. The numbers are reconciling. You're not being audited. The company taxes are being paid, and it's all fine and dandy. But over time, the profits start really sort of accumulating in the company, and all of a sudden you've got Division 7A problems, as an example, because you're taking money from the company that you haven't declared in the form of a wage or a dividend, as an example. Now, your accountant, being the accountant, the compliant accountant that they are, is now paying those sort of minimum repayments out of the company just to satisfy the Division 7A requirements. Now, interest is being applied every year. You're paying tax on that interest. But has the discussion ever been had as to, is that the best way to go about it? Is that the right structure for you? Do you have the right shareholding in place? Are you owning the right shares in that company? How are you extracting profits to actually invest? What is the asset protection risk here by retaining all those profits in the company? Should there be a corporate beneficiary, or a bucket company, more commonly referred to as? So it's really important to actually ask these questions. Are you actually having a tax planning session with your accountant to address all these things? And the tax planning session should also expand to your personal wealth goals. It shouldn't just be, okay, we need to pay this out just to remain compliant and make the ATO happy. No, it should really be a discussion around, okay, what are you trying to achieve personally? Are you trying to pay down debt? Are you trying to invest? How do we get these funds out of the company so that we can do so? So it's not really just a compliance matter. It becomes a wealth matter too.
But even if these things aren't addressed from the owner's perspective, from the business owner's perspective, everything can feel fine. There's no red flags. There's no penalty notice from the ATO. There's no audit. The accountant's responsive, reasonably priced, gets things done. But what happens is, 5 years later, or maybe 10 years down the track, when the business owner wants to, buy a property or bring on a new equity partner or exit, as in sell the business, suddenly things like, retained earnings, Div 7A loans, and the lack of planning all come to fruition. And so what could have been managed gradually or tax effectively now requires a massive cleanup. It's extra tax, limited options. And in this situation, it's not the result of any single mistake. There wasn't one single mistake. It was just a long series of unchallenged defaults. Not really the business owner's mistake. Of course, it's about understanding what service they're buying. And then if they do, they can sort of drive potential better outcomes. And it's also working with a better accountant.
And that's really the quiet cost. It's because quality is so hard to assess for a business owner like that. A technically competent and non-strategic accountant is never wrong, right? Because everything is working and everything's ticking along. And you're typically entwined in your business. You're just happy that things are ticking along. There's no penalty notices, like Stuart mentioned, and everything just seems to be okay. And they typically, to be very conservative, they'll follow last year's approach, just carry forward the same sort of conversations, the same sort of strategy approaches. They avoid sort of rocking the boat because they're just too concerned what might actually fall out of it. But quality in practice looks very different. It's almost an uncomfortable question. It looks like reviewing prior year decisions. Okay, did we make that wrong decision? If we did, how do we course correct? It looks like identifying where judgment exists, but it's slowing down there. Not everywhere, but where it matters. So for example, like we spoke about, the entity structure, the profit extraction, timing differences, ownership changes, succession, those are not line items, they are decisions. How do we approach those sort of discussions? What's our exit plan? What are we trying to do in our next 5 to 10 years? Do we need to, we previously spoke about an example for a client where they were only immediately available to access the small business CGT concessions now, but when they were going to retire in 5 years' time, they were definitely going to tick over the $6 million cap. So what we proactively did is actually sold the business now to an entity and got the right structure in place so that we can access it, gave him the uplift in cost base, and now when he's basically sold the business for over a 4 times multiple, he's basically sold it tax-free. So these are the kinds of conversations that you need to have to ensure that you're actually getting the benefit from a good quality accountant.
And this is where fee conversations can become kind of derailed or distorted. Quite often clients will ask, well, why should I pay more for accounting? Because it assumes that the marginal cost of buying more of the same thing, as in more lodgements or these sorts of things. But actually, what you're paying for is better thinking. There's probably a handful of key decisions that you might need to make in any one year. They might not be regular, they could be spasmodic, but these key decisions are the ones that if you nail can generate a lot of value. And so really choosing a better holistic accountant is really making a decision to make sure you nail those decisions. Whereas if you're going to choose an accountant based on price, that almost guarantees those key decisions will be rushed, even worse, ignored, or even worse again, dealt with reactively or after the fact. So this is not a sales pitch, to pay more for accounting services in some sort of abstract sense. It's really challenging the underlying assumption that price is the best proxy or measure of value for a service where judgment can have such a big impact on outcomes. Yeah, when a business is genuinely simple, like there aren't a lot of moving parts, there isn't a lot of judgment involved in preparing those compliance services, then in those situations, maybe the fairest or the best approach is actually to judge the service based on price. But in situations where there's greater complexity and there's more of these moving parts, there's more common decisions, then I think in that situation, you really need to think about using price as a measure for value, because at the end of the day, it's going to be the experience and the time and attention that that experienced person is going to expend on your situation is going to really determine its value. So there's a few questions you can ask, things like, to what extent does judgment exist in preparing my tax work each year? To what extent do decisions that I make today are going to have a future impact on my tax liabilities or flexibility or ultimate business health? To what extent do we carefully review tax returns and do tax planning each year or each time? Some of these questions help us understand, how much judgment is involved in the service that we're seeking, and therefore, whether we're going to judge or choose a holistic accountant based on price or based on level of experience, aptitude, other measures other than price, because ultimately price is what you pay, value is what you receive. And of course, you always want to pay a lower price than the value you receive in every circumstance. It just means where there's very little judgment, there's a lot of simplicity, then the value you receive will be lower as well, and therefore you should base your decision probably on price. But in circumstances where judgment is much higher, then of course the quality of that judgment will determine the outcomes, will determine the value you receive, and therefore judging a service based on price isn't the best approach. Like I said at the beginning of today's episode, we do have a conflict of interest, but we just wanted to talk about this judgment element in the service that we provide, because quite often it can be overlooked. And again, people might think it's quite binary. You prepare a tax return, you prepare some financial statements, and that might be true in some circumstances, particularly if it's very simplistic. But in situations where it becomes more complex, the judgment element is worth paying for. Okay, until next week, bye for now.